Currency markets have experienced significant volatility centered around the Japanese yen and US dollar exchange rate, with notable movements occurring as the pair approached historically significant levels near 160. These developments have coincided with substantial interest rate differentials between Japan and the United States, creating complex dynamics in global financial markets. Concurrent movements in precious metals markets and broader discussions about monetary policy coordination have generated analysis regarding potential relationships between currency intervention, carry trade positions, and systemic financial stability. We will examine this situation through three analytical frameworks. First, we will assess the documented exchange rate movements and the structural factors that influence yen-dollar dynamics. Second, we will analyze the relationship between interest rate policies and international capital flows, particularly carry trade mechanisms. Third, we will explore the broader implications for monetary policy coordination and precious metals markets within the context of global financial stability. The factual foundation begins with observable exchange rate data showing significant yen weakness against the dollar throughout recent months, with the pair approaching levels not seen in decades. The yen reached approximately 160 per dollar before experiencing rapid reversal in a matter of hours. This movement occurred against the backdrop of substantial interest rate differentials between Japanese and American monetary policies, where the Bank of Japan has maintained near-zero interest rates while the Federal Reserve has implemented significant rate increases. Japanese monetary authorities have acknowledged their responsibility to monitor exchange rate stability and have confirmed their readiness to take appropriate action when necessary. However, specific intervention operations, if they occurred, typically are not confirmed immediately due to standard central bank communication practices. Market participants have noted unusual trading patterns that some interpret as evidence of official intervention, though such interpretations remain speculative without official confirmation. The Bank of Japan's foreign exchange reserves and intervention capacity are well documented, with Japan maintaining substantial dollar holdings that could theoretically support significant market operations. The institutional framework for intervention exists through established procedures for emergency market stabilization, though implementation requires careful coordination between multiple government agencies and consideration of international monetary relationships. The structural context involves the carry trade mechanism that has operated for years based on interest rate differentials between countries. This trading strategy involves borrowing in low-interest rate currencies like the yen to invest in higher-yielding assets, often denominated in dollars or other currencies. The scale of these positions, while difficult to measure precisely, is estimated to involve hundreds of billions of dollars in related transactions across global financial markets. Carry trades create systematic vulnerabilities when exchange rate expectations change rapidly. Positions that appeared profitable under stable exchange rate conditions can generate substantial losses if currency relationships reverse quickly. The unwinding of large carry trade positions can amplify exchange rate movements and create feedback loops that affect broader financial markets. Interest rate policy divergence between major economies has created the fundamental conditions that enable carry trade strategies. The Federal Reserve IS rate increases to combat inflation contrast sharply with the Bank of Japan's commitment to maintaining accommodative monetary policy to support economic growth and achieve inflation targets. This policy divergence creates arbitrage opportunities that attract capital flows and influence exchange rate dynamics. The precious metals market has experienced significant price movements during this period, with gold and silver reaching elevated levels that some market participants attribute to concerns about currency stability and monetary policy effectiveness. Gold prices have approached historical highs, while silver has demonstrated substantial volatility. These movements occur within a broader context of inflation concerns, geopolitical tensions, and questions about the long-term stability of current monetary arrangements. The relationship between currency market stress and precious metals demand reflects traditional patterns where metals serve as alternative stores of value during periods of monetary uncertainty. However, multiple factors influence metals pricing, including industrial demand, mining supply constraints, and broader economic conditions that complicate direct attribution to specific currency events. The core analytical question centers on how modern central bank intervention mechanisms interact with large-scale private market positions and global capital flows. Traditional intervention tools were developed for different market structures and may face effectiveness limitations when confronting the scale and sophistication of contemporary financial markets. The integration of global financial systems means that intervention in one major currency pair affects multiple markets and asset classes simultaneously. The mechanism through which potential intervention affects market dynamics operates through multiple channels beyond direct currency purchases or sales. Market expectations about future policy actions can influence positioning and pricing, even without confirmed intervention. The signaling effect of potential official action can alter private sector behavior and trading strategies, creating market movements that reflect changed expectations rather than direct intervention impact. The timing and coordination aspects of currency intervention require consideration of multiple factors, including market liquidity, global trading hours, and relationships with other major economies. Effective intervention often requires elements of surprise to prevent front-running by market participants, while also needing sufficient scale to influence market sentiment and trading patterns. The key variable here is often overlooked in public discussion. The effectiveness of currency intervention depends heavily on alignment with underlying economic fundamentals and policy coordination between major economies. Intervention against strong fundamental trends typically provides only temporary market impact unless accompanied by broader policy changes that address underlying economic imbalances. Modern carry trade positions involve sophisticated financial instruments and risk management techniques that can amplify market movements during unwinding events. Automated trading systems and quantitative investment strategies may execute position adjustments rapidly when market conditions change, creating additional volatility beyond traditional intervention effects. The scale of automated trading in foreign exchange markets means that initial movements can trigger cascading effects through algorithmic position adjustments. This creates a dynamic where market intervention must account for not only immediate positioning, but also potential algorithmic responses that could amplify or counteract intended policy effects. The complexity of modern financial markets means that intervention outcomes may differ significantly from historical precedents when market structure was less automated and interconnected. Now, the second-order effects extend beyond immediate currency markets to affect global financial stability considerations. Large-scale carry trade unwinding can affect credit markets, equity valuations, and commodity pricing through multiple transmission channels. Financial institutions with significant foreign exchange exposure may face margin calls or position adjustments that affect their broader lending and investment activities. The precedent of coordinated monetary policy action, particularly references to historical agreements like the Plaza Accord of 1985, introduces additional complexity to current market dynamics. The Plaza Accord demonstrated that coordinated action by major economies could significantly influence exchange rate relationships, though the economic conditions and market structures of that period differed substantially from current circumstances. Contemporary discussions about potential coordinated action occur within a different institutional framework, with independent central banks operating under mandates that prioritize domestic economic conditions rather than international coordination. The feasibility and desirability of coordinated intervention depend on alignment of economic interests among major economies, which may not currently exist given different inflation, growth, and employment conditions. The enforcement mechanism for any coordinated approach would require sustained commitment from multiple economies over extended periods. Historical experience suggests that coordination success depends on underlying economic convergence rather than temporary policy alignment. Market participants understand these constraints and may test the durability of coordinated arrangements through continued trading pressure. Financial stability implications extend to banking systems and credit markets, where foreign exchange exposure creates potential vulnerabilities. Japanese financial institutions face particular challenges given the domestic bond market sensitivity to interest rate changes and the impact of currency movements on international investments. The relationship between exchange rate stability and domestic monetary policy effectiveness creates complex trade-offs for policymakers. We can identify three plausible scenarios based on current market dynamics and policy framework constraints. The stabilization scenario involves successful management of exchange rate volatility through a combination of market intervention and policy adjustment that reduces carry trade incentives without creating broader financial disruption. This outcome requires careful calibration of intervention timing and scale while maintaining credibility regarding long-term policy commitments. Early indicators for this scenario include sustained exchange rate stability within ranges acceptable to policymakers, gradual reduction in speculative positioning, and maintained confidence in Japanese monetary policy effectiveness. Precious metals markets would likely stabilize at elevated but not crisis levels, reflecting reduced immediate monetary uncertainty while maintaining longer-term hedging demand. The escalation scenario emerges if intervention proves insufficient to counteract underlying economic pressures or if broader financial stability concerns develop. This could involve renewed exchange rate pressure, large-scale carry trade unwinding, or broader questioning of current monetary policy frameworks. Precious metals could experience further significant price increases as alternative store of value demand intensifies. Indicators for this path include renewed yen weakness despite intervention efforts, broader emerging market currency pressures, or significant disruption in related financial markets. Bank lending conditions tightening due to foreign exchange volatility or substantial changes in global capital flow patterns would signal movement toward broader financial stress. The coordination scenario involves explicit policy coordination between major economies to address underlying imbalances that create currency market pressure. This could include coordinated interest rate adjustments, formal exchange rate agreements, or broader monetary policy framework changes. Such coordination would represent significant departure from current independent central bank operations. Key indicators include formal statements about coordinated policy action, simultaneous policy adjustments by multiple central banks, or explicit exchange rate target announcements. Successful implementation would require sustained political and economic commitment that addresses underlying structural imbalances rather than temporary market pressures. Each scenario carries distinct implications for global financial markets and monetary policy effectiveness. Successful stabilization would demonstrate continued viability of current monetary policy frameworks while highlighting the importance of intervention readiness in highly integrated financial markets. This outcome could provide templates for managing future currency market stress while maintaining central bank independence. Escalation would reveal limitations of traditional monetary policy tools in contemporary financial markets and could accelerate discussions about fundamental monetary system reforms. Significant financial disruption could force policy responses that prioritize immediate stability over longer-term institutional arrangements. Coordination would represent substantial evolution in international monetary management, but could also create new vulnerabilities through increased policy interdependence. Enhanced coordination might improve crisis management capabilities while potentially reducing individual country policy flexibility. Our analysis reveals several confirmed patterns and areas requiring continued monitoring. Exchange rate volatility reflects underlying economic divergences that create structural pressure beyond temporary market positioning. The scale and complexity of modern financial markets present challenges for traditional intervention mechanisms that require careful consideration of effectiveness and unintended consequences. Interest rate differentials and carry trade dynamics demonstrate how monetary policy decisions in major economies create global financial spillovers that affect stability in multiple markets simultaneously. The relationship between currency markets and precious metals pricing reflects broader concerns about monetary policy sustainability and long-term value storage that extend beyond immediate exchange rate movements. However, significant uncertainty remains regarding the optimal balance between market intervention and underlying policy adjustment. The effectiveness of intervention in achieving lasting exchange rate stability without addressing fundamental economic imbalances continues to be tested through market dynamics. The potential for coordinated policy action depends on political and economic factors that extend beyond technical monetary policy considerations. We will continue tracking confirmed exchange rate movements, official policy statements, and related market developments as they emerge. The interaction between monetary policy effectiveness and financial market stability provides insights into contemporary challenges facing central bank operations in globally integrated financial systems.